Hello and welcome. My name is Benoit Paliquin, and I'm lead portfolio manager and one of the partners here at Exponent Investment Management. This video is for you to learn how to track your performance using our NDEX client portfolio software or portal. The first point is you can access the client portal through our website, www.exponent.com, and there's a hyphen between the EX and the P, and click on Client Area. From there, you would click on the NDEX portal, which will then take you to the software itself, and then from there you click the language, and your user ID and password will be required for you to enter. The user ID and password were sent to you via the client welcome binder, the white binder that was carried to you when you became a client of Exponents. Once you've clicked all through the web page, it takes you to this viewing. So ultimately, let's go from top to bottom and left to right and go through this page. So the first top part is the client. You can, if you have multiple accounts, so you might have a holding company, an RSP, your account, your spouse's account, maybe a registered disability plan, or maybe an education savings plans. All of these accounts, I should say, are can be viewed as a household or individually. As we move to the left hand, we see this static menu. And we're really going to focus today on rates of return, ROR, and a couple of the report functions that we will access. So it's important to remember that the left-hand menu corresponds to the account that you're looking at. So when you're looking at a household, we're really focusing on the hashtag. But you can also click on another account, and the page will then load and specifically focus on your account. And the left-hand menu corresponds to the accounts that you're looking at. So let's go back to the household menu. The next thing to understand is the different columns in the web page. So you've got the percentage of total of each positions. We have a summary of the said positions here. It's probably easier with the stock here. So the positions, we have Canadian stocks, bonds, which we highlighted a little earlier, cash or reserve, American stocks, and European stocks, or ex-North American stocks. And then we have the number of shares owned, and these can be those are held through multiple accounts, and then the total tally. We then have the average cost for the position, and if it's a foreign stock, the cost will be based in US dollars. And then we have the market price, the closing price, and in between we have the book value, which is in foreign stocks. We can click on this. You will see the number of shares purchased, the price per unit purchased, but also you will have a foreign exchange adjustment, which translates to the book value. We then move on to the market value, whether the position is up or down, the estimated income for the next year, and how much income we have received from the position since it's been owned. Finally, the unrealized gains and loss. Now, many clients will come to us and say, well, Benoit, in this particular account, the account is down if we compare book value to market value, and so that's not a great performance. And this point is very important. The book value of the overall account is not necessarily what the investor contributed into the account. It is simply a tally of all the cash balances of all the stock positions, the bond positions. So what happens is that if that overall book value will fluctuate over time. In fact, it'll probably increase over time. It'll increase for two reasons. Number one, the income on the securities, so the dividend and the interest payments that are paid into the account come back into the cash balances. And so in this case, if we've received $12,000 or $10,000 in interest income, this $10,000 would have made its way into the cash balance, thereby increasing the book value by $10,000. The other way the account book value increases is when we realize a gain. So let's look at a live example. Let's just say that we sold L'Oreal, and we booked or realized a $13,500 capital gain. So if we sold the stock, $42,000 would be the proceeds using yesterday's close, and the cost on that position was $29,000. So clearly there's a gain there, and so when the $42,000, the proceeds, come into the cash portion of the account, the differential, the positive differential, increases the book value. So in this case, the book value would increase by $13,000, or effectively the realized profit of the trade. Alternatively, you can reduce the book value in an account by taking a loss. So if we were to sell all of the AltaGas positions using yesterday's close, we would actually have booked a $7,700 loss, and that $7,700 loss would reduce our book value. So how do you track the performance? You certainly can track the performance of each stock individually. You can click on, just make a quick comparison between the average cost and the closing price. You can also click on the underlying position of the book value, which will give you a history of the position. So in this case, all of the dividends have come in, and also the subsequent purchases that we've made. So in this case, we purchased Bank of Nova Scotia. So the best way to track your performance is one of two ways. The first one is to click on this rate of return, or ROR function, which will launch another window. Sometimes these windows will be blocked, so make sure that you unblock them on your web browser. So what we see here is the rate of return window or function. First of all, this function is reset or updated every month, at the end of every month. So if we're currently in May, we're looking at April month end. Secondly, we also include the currency as of April month end. And finally, we can toggle between Canadian dollars and US dollars, and we can toggle between including the currency impact and excluding the currency impact. Typically, in the short term, the currency will have, so short term being a year, the currency will have a large impact. Over a longer time period, 2, 3, 4, 5 years, the currency does tend to ebb and flow, and the ups and the down do tend to cancel each other out. But in the short term, their currency fluctuation of our Canadian dollar versus the US dollar will certainly have an impact on the short term performance. But typically, we always keep the currency included in the study. So from there, the first column is the periods, or the titles, I should say, of the lines. So we have the beginning period, the date. So if we go back 1 month, obviously, and we're looking at April month end, we would be going back to March month end. If we go back 3 months, we're going back to January. If we go back to the beginning of the year, we're going back to December. The next line down is the value of the accounts at the corresponding dates. The next 2 lines is sometimes can be a point of confusion, is the inflows and outflows. So the inflows would be deposits, transfer ins, and also flows from other accounts. So if you remember, we have Canadian side and US side to all of your accounts. Let's just say we buy Pepsi Cola. It trades in New York, therefore we need to purchase it on the US side of the account. This would mean that we would have to convert Canadian dollars into US dollars, meaning we would have an outflow of the Canadian side of the account into the US side. So this inflow-outflow will cancel each other out. So obviously if we move, say, $10,000 from the Canadian side into the US side, the inflow-outflow will cancel each other out. So over the long term, flows will offset each other. The net being simply the deposits or withdrawal. So in this particular example, we see a $6,000 withdrawal in the last month, and we see some ebbs and flows of US dollars and Canadian dollars. Finally, we have the ending value for the month of April. That is steady all the way through. And the important concept of this function is the net invested capital. That is the summation of all the deposits into the account over time since the account was open, less any withdrawals. And so if we compare this amount, which is 1.456, and go back to our book value, we can see that it's significantly different. The net invested capital is significantly smaller than the book value. So in this particular case, the client is up over $400,000. However, it's a function of realized gains in the past that have, and income realized, that have increased this book value of the overall account. So the rate of return function is very important to track and maintain good accounting in terms of how many dollars did you invest with, or did you entrust to Exponent. The other function that is very useful to track your performance is found in the reports function. So you click on the reports function, and we will focus on specifically two performance functions. The first one is called the rate of return report, the ROR. Interesting thing here is you can select the dates that you want to specifically study, and you can also select certain benchmarks if you wanted to compare the performance of the account over a specific benchmark. Secondly, and I think most importantly, is the monthly rate of return report. This will track the performance of your account, but will break it down on a monthly basis. Simply check the box, then select from inception and the last completed month, in this case the end of April. I like to check monthly and yearly. Click on create, and from there what you will see is a reproduction of the ROR function. You will also see the net invested capital. What is most interesting is the net invested capital, which is the green line, is flat, and the orange line is the market value. And the idea is, as people reduce or withdraw their capital, the idea is to track the comparison or the differential between the net invested capital and the market value through time. Finally, we get to the monthly rate of return report. This tracks, as the report states, the return for each month. Why I find this report very interesting to watch and study is the lumpiness, if you will, the volatility of the return. So in this account, as we deployed the capital into a falling market, we actually had a short-term negative performance, which quickly turned around in the early part of 2015. We closed the year with a 5.5% return net of fees. We also can see the inflows and outflows, and we can see how they cancel each other out. As we move through time, the following year, 2016, was quite a good year, and so we made up. If our target return is 6 to 8% for such an account, we can see that this return is certainly not linear in fashion. The following year, 2017, was 4.3%, and here we are flat for the year so far. So to recap, this report will track the monthly rate of return of your account, but tracking the cash flows on a monthly basis and tracking the returns on a monthly basis. You can read this report. The first column is the period of time you want to be looking at, the beginning value for set period, the inflows and outflows. If it's simply a foreign exchange transaction, it will cancel each other out, the ending market value, and the rate of return for the period studied. That concludes our short video on tracking your performance using our client portal. Thank you very much for watching. As always, if you have any questions, do not hesitate to contact us. Thank you very much for watching, and have a great day.